now I have completed the four chapters: the business finance and the dividend policy. Next is the cost of capital and the capital structure. So I have completed the four chapters, and from these chapters we will solve all these questions. Okay, and I'm using the Kaplan exam kit, which is latest, the 25 and 26. Okay, so let's do this question. What is the required return on the shares? What's the required return? Which means we have to calculate cost of equity. Okay, as decimal. The equity shares of NIS have a beta value of 0.80. Okay, so beta value is given. So we have to calculate this cost of equity using CAPM formula. What is the formula for this? We have the formula for this: risk-free return plus beta equity multiplied by risk premium, or I can say the market return minus the risk-free return, or this is the risk premium. Okay, now this is the beta equity required risk-free. This is RF and risk premium, and the tax rate is 30. Okay, so let's put these numbers. Risk free is 6 plus 0.8 and market return, and this is the risk premium we have given, the 4. Okay, so how much? 4 multiplied 4 multiplied 8 4 multiplied 0.8 equal 0.2 plus 6, 9.2%, right? Next is, what is the which two of the following is correct? Okay, a bonus issue can be used to raise new equity finance. So bonus is a free issue. Bonus is free, no cash raised. Means it is given free of cost to the shareholder, so we don't receive any amount. Okay, so it means we are not raising any finance from this, so this is incorrect, right? A share repurchase scheme can increase both earnings per share and gearing. Share repurchase, when you repurchase shares, can increase EPS and gearing. EPS earning per share, EPS earning, earning divided by number of share. So repurchase means decrease in number of share. So decrease in number of shares. So means increase in both. Increase in EPS, because the number of shares decreased, so the earnings that is distributed between the existing shareholders will be higher, so the earning per share will increase. Okay, and gearing is debt divided by equity. So now the equity shares have reduced. Okay, the company repurchased the shares. Okay, So repurchased shares, repurchasing shares will decrease the share capital, equity share capital. So equity share capital decreased, so debt will be higher in proportion to equity. So this amount debt will be higher in proportion to equity because equity share capital decreased due to repurchase. Okay, so this make it increase. So gearing will increase, right? Gearing will increase. So this is correct. M&M argued that the financing decision is more important than dividend decision. No, the financing decision is irrelevant because in M&M, it says that either you take either you take either you take debt or equity, either you take debt or equity, and this is WACC, this is debt, and this is equity. Either you take debt or equity, the finance, the debt will remain same, the cost, and equity cost will increase. So there is no change between them. So the company will be indifferent. So it is not argued that financing decisions are more important than the dividend decision. So financing decision is not important. Okay. Shareholders usually have the power to increase dividends to annual. No, because directors decide the dividend. Offering new shares to tender may mean that not enough funding is raised from share issue. So not enough funding raised from share issue means that offering new shares for tender may mean that not enough funding raised from share issue. So it means that mm, when you issue shares through tender, so the buyer buyer bid buyer quote the price, so that price can be lower can be lower can be lower. So your funds may not be may not be fully you may not get full amount, because if you are expecting that I will raise 1000 for 100 shares at 10 each, okay, but what happened that 100 shares are only get issued at 8, so they are interested in buying at 8, so you only raised 18, not 1000. So that's why there is not enough funding raised from these shares issued, because in tender it is not compulsory to buy at 10, so they can they can quote the lower price as well. So usually the buyers quote the lower price, and the not enough funding raised from the issue, right? Okay, so E is correct. So B and E is correct too. Okay. Next is which within which ranges will the equity beta of B and C lie? Okay, equity beta. A, B, C, and D company percentage equity in proportion to total market capitalization, debt in proportion to total market capitalization. So here beta we have for A it is 0.89, for D it's 1.22. Okay, so we have these beta, equity beta. So what is the relation that for A it's 8.9, for D it's 1.22, it increased. So this debt is from 30 to 60, it increased, but here the equity has decreased, so there is relation between this and this. Okay, so I can say that for this beta B company, for this B company, the beta should be is 30, it is 30, so it has 8.9, so it has 60, it has 1.22 beta, so it has that beta of 80%. So the beta must be above, so beta must be above 1.22, because the debt is higher, because that percentage is higher than this 60%. Okay, so the beta must be above than this. Okay, and here the debt percentage is lower than this, sorry, higher than this but lower than this, so it must be between 0.89 and 1.22, because this beta and because this debt percentage is between and this 30 and 60, so it must be the beta also must be between 0.89 and 1.22. Okay, so the answer, the beta for the B company and the beta for B company are both higher than 1.22. Beta for B company and C company is below. Beta for B company and for C company are both higher than 1.2. Wrong. Beta for B company is below 0.99. Beta for B company below 99. No, beta for B company is above 1.22. Okay, and beta for C company range between, this is correct. Okay, so this must be the answer. Which two of the following statement concerning profit are correct? Accounting profit is not the same as economic profit. Yes, true, because accounting profit includes total revenue minus explicit cost, but economic profit means explicit plus implicit cost, explicit plus implicit cost, both cost must be deducted from total revenue. Okay, so this is correct. Profit takes account of risk. No, profit don't take any risk account. There is no relation between this and profit. Accounting profit can be manipulated by managers. Yes, yes, because accounting profit have estimates like counting estimates and accounting policies. So due to this, accounting profit can be manipulated. Okay, so gross profit margin is calculated as gross profit divided by shareholder, GPM. GPM is GP divided by sales divided by shareholders fund. So this is wrong. Okay, this is correct. What is the what is the current net cost of capital per year for these loan? for this loan. Company issued its 12% irredeemable loan note at 95. The current market price is 92. The company is paying corporation tax rate 30%. The irredeemable debt. So you have to calculate the cost of capital of irredeemable debt. Okay. So for irredeemable debt, what is the formula? I 1 minus T divided by market value, market price, or you represent it P0, that must be, sorry, there is no dividend in case of debt, so its uh, interest is calculated on 100, that nominal value we assume for 12 1 minus t 1 minus 0.3 divided by p0 92. Well, the current market price is 92. So the cost is 88 by 92 multiplied 100. So we have this 9.13. Question number 128. What is the company's weighted average cost of capital, WACC? You need to calculate WACC for capital investment appraisal. Okay, you need to calculate WACC. So in order to calculate WACC, you need to cost, weight, cost multiplied weight. Okay, and you do this WACC calculation here. So I will write here this K is 18, K, KD, KF, and KD. K is 18 and KF we have the 8%. We need to calculate this. KF, cost of reference here, 8 multiplied $1, it is issued for 8% divided by 0.2, that is the price. Okay, so this is the formula I will write here, is interest divided by 0. Sorry, we have to say this dividend. Okay, so how much is this? Is 0.087 of that is I1 minus T divided by market. Okay. The interest is that is 100 multiplied 12.5%, 1 minus 2.3, the tax, divided by the this market value, the price, That is 100. How much is this? This is 0.0875. The weight, the cost of equity, the weight is the market value. So this cost of equity is 12 per million. Cost of finance, the current is 6 divide 1 multiplied the price 5. So this is that it is 8 divided now we have to this market value we have to write here so that we calculate the weighted average cost of capital. So this market value will be treated as weight because we have to calculate the weighted average cost of capital. Now we have to multiply this to this and the total. Okay. So 18 multiplied 60. 18 multiplied 60. 60 have 080 5.52 multiplied 8.7 equal 848 and 8.75 multiplied 8 equal 77 plus 8 plus 0.8 equal 198. This is 60 plus 80. 1198 divided by the weight 74 16 16 point means this is 16%. 16. So indicate by clicking in the relevant boxes whether the following statement is true or false. Okay. An increase in cost of equity leads to fall in share price. No. No, actually it's correct. Increase in cost of equity means increase in WACC as well because cost of equity is the part of WACC. It is included in WACC calculation, so this will increase as well. When WACC increase, the NPV of a project decrease, which means the shareholders' wealth reduced. When shareholders' wealth decrease, the shareholders sell the shares in the company and the share price will fall. So this is true. Investors faced with increased risk will expect increased return as compensation. Yes, increased risk. When the risk increase, they expect the increment in. When risk increase, the return must be increased. Okay, this is correct. So the cost of debt is usually lower than the cost of preference share. So cost of debt is lower than cost of preference share. Cost of debt usually is interest and which is fixed. So fixed interest, fixed income, the debt holders receive. So when they receive the fixed income, so their lower risk they face the lower risk. When they face the lower risk, so means they expect the lower return. So lower return or return, which is the cost. Okay, company has assuming that the dividend growth rate is 16%. What is the cost of equity capital? What is equity capital? Okay, of equity T equal its cost of equity capital. Assuming that dividend cost of equity capital, dividend divide market value, dividend divide market, dividend divide market value plus G plus G. Okay, so dividend how much? And is 25.6 1.0 plus 1 plus 0.0 16.6 divided by market value. How much? The market value is 280. 80 plus 0.6. Okay, so let's calculate this. $25.256 side 1.16 equal divided by 280 equal plus 0.16 equal right 26.60%. Is 60. Actually, this I forgot to take this X div market value. X div must be X div. So the dividend come div. So dividend, this ordinary dividend, this must be deducted. 25.6 be deducted. 6 okay. Plus 0.16. 25.6 multiplied 1.16 divided 39.696 divided 280 minus 5.6. 5.6, this is the dividend, so we have 0.4 plus 0.6. So 39.696 divided by 254.4 plus 0.16. So the answer is 0.267. 7%. 27.67, and this is the correct answer. Which two of the following would be implied? Which two of the following implied by a decrease in operating gearing? So, do you mean what is operating gearing? Operating gearing means fixed cost. Okay, and what is going here, the fixed cost is decreasing. When the fixed cost is decreasing, what will happen? So these are some of the options. The company is less profitable. No, it is more profitable. So this is wrong. The company is less risky. So when the gearing decrease, when the fixed cost is decreasing, which means that the risk, our risk of paying the fixed cost in case our profit decrease, so we have less burden of paying the fixed cost, so which means that our risk has decreased. So this is correct. Okay, so next is the company has a lower proportion of cost that are variable, lower proportion of fixed cost which is variable. Okay, lower proportion of fixed cost because the fixed cost is decreasing, so lower proportion of fixed cost, not the variable. This is wrong. Company has profits which are less sensitive to changes in sales volume. So it is here that the company has profit which are less sensitive. So means if the fixed costs are decreasing, means the profit are less sensitive. If if the if the sales if the sales changes, sales volume change, the profit effect will be less, the profit effect will not be much. If the sales volume change, the profit will not change as much, because the gearing, the fixed cost, the operating gearing has now reduced. That's why we already understand this. If the sales volume change and sales change, the profit also change in case we have the high operating gearing. But here it is decreasing the fixed cost, so it is less sensitive. So this is correct. Okay, also you can tick this answer by when you know that this one is wrong, this one is correct, and this one is wrong as well, and you have to select two options. Okay, then this is the one and this has to be the second correct answer. Okay, so next is the which of the following statement is part of traditional theory of gearing. In traditional theory, what will happen? We have to understand this. Let's draw the diagram. Let's draw the diagram. The fixed cost, that the gearing will be like this. Okay, or I can draw this more deeper. Okay, the gearing is like this, and the weighted average cost, let's draw first the cost of equity. Cost of equity is here like this. Okay, and the weighted average cost is like this. So this is the somewhere we have this KE, cost of equity, this is the cost of debt, and this is the WACC. And we have the optimal capital structure, where we have the lowest lowest WACC, a mix of debt and equity where we have the lowest. Okay, so and if the let's draw the market value diagram as well. So when the you know that when weighted average WACC decrease, so market value increase, market value of company increase. So now in now it's decreasing, so market value will increase. Now it's decreasing, market value increase, market value increase. But what happened later? It has decreased, so market value will decrease later. Okay, this is the market value. Okay, now let's do this. Which of the following statement is part of traditional theory of bearing? So there must be taxes. So we assume that in the traditional theory there is no taxes, no taxes. So this is wrong. There must be exist a minimal WACC. So this is the minimal WACC, the optimal capital structure. So this is right. The cost of debt increase as gearing increase. So you know that when at some point that the cost of debt remains same, but it increase when the debt increased, debt in the capital structure increased, but the cost of equity increased from the beginning. Okay, but debt increase when we further increase debt from this point, when we go at the end. Okay, so cost of debt increase as gearing, cost of debt increase as gearing debt decrease. No, cost of debt increase as, okay, cost of debt increase as gearing decrease. No, gearing is this part, means gearing is the total fund we borrow from the debt. So it says that cost of debt increase, yes, increase. But when the debt increase, cost of debt increase when the debt increase, because the debt holders they anticipate that when the company don't have the profit to pay the debt, then our our capital cannot be paid by the company. So when the company have too much debt, so obviously he cannot pay the debt when it is required, right? So this is correct. I mean the cost of debt increase as gearing decrease. No, when cost of debt as gearing increase, as gearing increase. So this is incorrect. Okay. Cost of equity increase as gearing decrease. This is also wrong. So B is the correct. Next is which of the following is true? Which of the following is true in case of scrip issue with perfect information? Scrip issue means bonus issue, free share, bonus issue by company, no capital, no capital or cash raised, right? Company don't receive any money. And perfect information when buyer have same information as company have, same information, and react react instant. Okay, so the share price reflect the true price of the company. Okay, so the EPS decrease in EPS if the if the company issue bonus shares, the EPS decrease, right? So EPS decrease, let's understand EPS, earning divided by number of share. Okay, so the number of shares increased. Okay, so this earning is same, the number of shares increase, so EPS will decrease, right? Previously it was $100 distributed in 8 in 10. Previously $100 distributed in 10. Okay, so now it's 10. But now what happened that this $10 earning is distributed among 15. So now this is very less than 10. How much is this? This is 6.67. 6.67 is the EPS. So this has to be decreased. This has to be decreased. Decrease in earning per share. This is right. So next is decrease the debt to equity ratio calculated on market value basis. Okay, so debt to equity ratio, debt value and equity value. Debt value and equity value. You have to take the debt capital and equity capital. Okay, so what happened that there is no no cash issued, so the debt will remain same and equity will remain same as well. So there is no change, right? There is no change in this. No change because the equity shares are bonus issued. There is no cash received from the equity holders that to whom we issued shares. Okay, so there is no change. Increase individual shareholder wealth. Increase shareholder wealth. Let's understand this. Increase shareholders wealth. Actually there is no increase. Why? No change. Because let's take an example that previously we have the $100 at 50. This is the share price. This is the capital. Okay, this is the capital. But we get 110 10 more shares. Okay, 110 at the rate 50. 110 at the rate 50. And this 110, the price will decrease. So it will decrease by 45.45 and the value will become 5,000. Okay, initially it was 5,000. Then when you get bonus issue, when you get bonus shares, your shares increased, the price same. Okay, so your market value become 5,500. But what happened after the bonus issue? The price market value decreased. When the market value decreased, your shareholder wealth, your wealth has become 5,000 again. Okay, so there is no change. In that. Increase in market price of the share. No, it will decrease in market price. Okay, this is wrong as well. Next is a company incorporates increasing amount of debt. A company incorporates increasing amount of debt finance into capital structure. Increasing the debt in the capital structure while leaving operating risk unchanged means fixed cost. Company incorporates increasing amount of debt finance into the capital structure while leaving its operating risk unchanged. Okay, increase in debt but the fixed cost will remain unchanged. Okay, so assume that a perfect capital market exists, which means buyer and seller have same information and the share price will react instantly. Okay, with corporate tax. With corporate tax means M with tax. Okay, M with tax, but without personal tax. Okay, So, which of the following correctly describes the effect on the company's cost of capital and total market value? Effect on cost of capital and total market value. Indicate by clicking in the relevant boxes whether the cost of equity, WACC, and total market value would increase, decrease, or unaffected. So we have to tick whether after in the M&M with tax, whether the cost of equity increase, decrease, or unaffected, WACC increase, decrease, or unaffected, and the market value. For this to understand, we have to draw the M&M with tax. So in M&M with tax, what happened that the cost of equity, the cost of debt, the cost of debt, the cost of debt will remain same, and the cost of equity will increase, right? The cost of equity will increase, but because of tax are getting the tax benefit, so our WACC will decrease, so WACC will decrease. Okay, so this cost of equity will increase and WACC will decrease. And total market value, you know that when the WACC decrease, the market value will increase. So market value will increase. So you have to draw whenever you find any questions on the M&M theory. So you have to draw this diagram and then tick your answer correctly. Okay. Next is which if for a given level of activity a firm's ratio of variable cost to fixed cost are fallen, variable cost were fallen, which means that if the variable cost and fixed cost ratio fallen, which means that variable cost is fallen, decrease in variable cost. Okay, so we have the formula that is fixed cost divided by variable cost. Okay, so if the variable cost fall, so what happened to the operating gearing? This formula is called operating gearing. So operating gearing will increase because the variable cost fall in proportion to fixed cost. So fixed cost will remain same, but the lower proportion, the variable cost fall. So the fixed cost will automatically in proportion to variable cost, this will increase, and the operating gearing will increase. Okay, at the same time the ratio of debt and equity were to fall. Debt and equity fall. Debt and equity, what is this? Financial gearing. Okay, so what would be the effect on the firm's financial and operating risk, indicated by clicking the relevant boxes whether financial increase or decrease. Okay, and this operating gearing, we can say that risk, this is operating risk, and this financial gearing is financial risk. Okay, so this is financial this financial gearing will decrease, right? And this operating gearing will increase. Okay, question 136, a security's required return. Okay, let's first read what does this information indicate. What does this information indicate about the pricing of security X and Y? About pricing of the security X and Y. Okay, fill in the gaps in the statement below. So we have to tell whether this security X is overpriced or underpriced, and this security Y is overpriced or underpriced. Okay. Okay, so let's read the question. A security the required return can be predicted using CAPM. So required return is cost of equity. The security is the equity, and we are using the CAPM formula. So the required return can be calculated using cost of equity and this formula is used here is CAPM, okay, and this formula is given here. This is the cost of equity, the RI, okay, and this is risk-free return. This is risk-free return, risk-free return. This is beta, okay, this is beta, and this is the beta means the risk measuring unit. It is called the beta, and the market return minus the risk free, okay. So the security X has a beta value 1.6 and provides a return, and providing the return 12%, and security Y has the beta value of 0.9 and provides return of 13%. So these are the beta value given for X and Y, and this is the return that they are providing, 12% and 13%, okay. And security Z has beta value of 1.1 and provides return of 13.2%, okay. And security Z is correctly priced, which means that this return is provided correctly. This return is provided as expected. So if this return is provided as expected, so can we say this is the cost of equity? So can we put this into this formula and calculate the uh, this uh, this market return? We have to calculate the market return, okay. So 13.2 equal risk free is 6 plus the beta is 1.2, the RM minus the RF is 6, okay. So 13 minus 6, sorry, 13.2 minus 6 equal 1.2 RM minus 6, sorry, 1.2 RM multiplied 0.2 RM, okay, RM 10.6 RM minus 6, yes, right, okay. Okay, so let's simplify it, okay. Let's simplify it, that if this is 12 RM minus 6, then we divide this, by 12. So 13.2 minus 6 divided 12, okay, and RM minus 6. So let's solve this. Understand, this will be 13.2 minus 6, 13.2, 6 equals 2 divided by 12, 12.6 divided by, oh, actually this is 1.2, not 12. So we have to divide it, 1.27 divided by 2 will be 6. 6 equal RM minus 6. So RM, all this will go this side and will be added, okay. So minus minus will become 12 RM, okay. 12 RM is the market rate, okay. So now we have to calculate the security cost of equity of security X and security. So security X equal to 6 plus 1.6, and this is the right return of L is the RM. No. This is the 12 RM. Okay, 12 RM minus the risk-free return is 6. Okay, let's calculate this. 12 minus 6, 6 plus 1.6 multiplied 6. Okay, so how much is this? 6 multiplied 6, 6 multiplied 6, 12 plus 6, so 15.6, 15.6, 15.6, the cost of equity of security X. Okay, and for Y, it is, let's calculate here, the for Y it is 6 plus 0.9, 12 minus this 6. Okay, so the answer is 11.4%. Okay, 4%. So here it is providing, here it is providing the security X is providing the return 12%, but it should provide 15.6%, and it should provide 11.4%. Okay, this has to provide 15.6 instead of 12, and this has to be for 11 instead of 13. So which means that it is this security X is providing lower return, so it is providing the lower return, and this security is providing the higher return. So why it is providing the lower return? Because we bought, because lower return, higher return, because bought at expensive price, okay. So, and this one is providing higher return because bought at cheaper price. So when we buy at cheaper price, so our return will be higher. So for example, if the value of the price of any goods is $10, okay, and you bought it at 8, so 2 is the profit, right? To the profit or your return. But if you bought it at 12, and the price is 10, but you bought it at 12, so you have the loss of 2. That is the loss. It means lower return, right? So here is the same case, that your return is lower because you bought at expensive price. So it means that security X is overpriced, and security Y is underpriced. Okay, let's do next. Next is the what is the market value? What is the market value based gearing? What is the market value based gearing defined as prior charge capital? Prior charge capital is debt. Prior charge capital, that is also known as prior charge capital, and the equity. So we have to take the debt value and the equity value. Debt and the equity value. Okay, so what is the debt value? That is here, that is bond. The ordinary shares have a nominal value. This is the nominal and this is the market price. The preference share, preference ordinary nominal, and the trading at 80 cent. Bond has a nominal value and trading at 105. Okay, so bond here, the nominal is 4,000 divided by, okay, let's do this. 4,000 divided by 100 multiplied by 105. How much? And this bank loan is at the same price. Okay, the same price is for the bank loan, and the preference share is nominal value is 1 and trading at 0.80 cent. Okay, so now calculate this market value. 4,000 divide 100 multiplied 105. 4,000 divide 100 divide 105 equal to 4,200. 4,200 for this 1,600, and this will be 1,600, right? 8 1,600. So what is the total? Total is 1,600 plus 6,200 plus 6,200 or 1,200. 12. Okay, and the ordinary share value is valued at, ordinary share value is valued at, is valued 0.5 and trading at 5. Okay, 8,000 divide 0.50 all multiplied 8,000. Okay, this is 12,000. This is 80,000. And we are considering that this reserve is not part of S. This is our assumption that this reserve are not part of ordinary share. Okay, so let's do this. That is 12,000 and this equity is 80,000. 15%. Okay, the answer is 15%. This is very simple. Just you need to calculate the market value and then just put in the formula and you will get it. Okay. Next is fill in the gaps in the statement below. Okay, you need to fill the blank. Choose from the following. Risk that cannot be diversified. Risk that cannot be diversified is systematic risk. Okay, this is the systematic and is general. Systematic risk that cannot be diversified, and unsystematic is specific risk that is specific to a company that can be diversified by investing in different portfolio. So the Risk that cannot be diversified is systematic risk. Okay, risk that increase as a company gears up. It is described as gears up means increase in debt, gearing increase. The gear up means gearing increase and the debt increase. So this risk is called the financial risk. Okay, financial risk. Next is indicate by clicking the relevant boxes whether the following statement are true. Okay, true for the company, whether the following statement are true or false. An all equity company issued. This is the all equity company, only has the equity capital, but now they are issuing the irredeemable loan note. Okay, that never repaid. Okay, to the finance of a project that has the same risk as existing project risk. Okay, same business risk. The company operates in a tax-free environment under the conditions of perfect capital market. Okay, tax-free, and we are the perfect capital market. These are the assumption of M&M, M&M, no tax. So in M&M, no tax. Let's draw this chart. In M&M, no tax. The cost of that will be same, and this WACC, sorry, the equity will increase cost of equity, but the cost of WACC will remain same, right? This is the diagram, and the market value will also remain same because the WACC uh, is constant. Okay, that's why market value will remain same. The cost of equity will fall. The cost of equity will fall. This is false because cost of equity will increase. uh, in this M&M theory, cost of equity will increase. Okay, increase. A weighted average cost of capital will rise. No, this is also false because the weighted average cost not rise. This will constant. Okay. Next is which two of the following are most likely to result in a company's financial gearing being high? If a company has high gearing, if a company has high gearing, high financial gearing, which means that high debt. So what happened to a company who has high debt? So high debt company will have lower taxable profit, which means that the interest is tax deductible. So this profit is profit before tax. This interest will be deducted here. So profit available, profit before tax, profit before PBIT, profit before interest and tax, and this is profit before tax. So this will be lower because this uh, interest is deducted. So if this interest is not deducted, this will be higher. So this is correct. High tax rate. High tax rate means that there is a high tax rate. So I mean, there is no relation between the high gearing and high tax rate. Tax rate is defined by the government. Okay, so this is not correct. Okay, inexpensive share issue. There is no relation between issue cost and and the the debt capital. Okay, so intangible assets being a low proportion of total assets. Okay, this is complicated. Let's break down this. It says that intangible assets will be lower in proportion to total assets. Okay, this means that if the debt, if we issue that means we, oh, if we issue that, if a company, if a company issue debt, so it is assumed that it has assumed, or you can say that it is generally secured. It is generally secured against against the assets, and these assets are tangible assets. So right now the company is issuing the debt, or has the high gearing, which means it has the high tangible assets. So if the company has high tangible assets, which means it has the lower intangible assets, okay, in proportion to the total assets. Okay, so this is correct and this is correct. Okay, but in your exam kit, this answer is correct and this is not correct. So actually this must be correct, and this has no relation with the debt, and it is tax rate is defined by the government. But what the explanation given by the exam kit, the explanation given is that the high tax rate means this profit before tax, this profit before tax, this will get the tax benefit, because this amount will get the tax benefit. So this means that this has higher tax rate. This tax benefit is considered as higher tax rate, but this is not correct in the actual sense. Okay, so this has to be the correct answer, actually. Next is, compared to ordinary secured loan notes, which of the following statement is true when considering the convertible secured loan note? So one side we have the ordinary secured loan notes, and the other side is convertible secured loan notes. So convertible means convertible has the benefit. So they are issued as debt, but they can be convert into equity after a period. So this is the conversion. This conversion is the benefit. Okay, this conversion is the benefit. So which of the following statement is correct? Likely to be more expensive to service, because this convertible loan note is expensive to service because of equity component. This statement is saying that because of this equity component, this you can convert it into equity, that's why it is more expensive. Expensive means the cost of debt is higher. Instead, the cost of debt is the convertible secure loan note is lower, because they have the benefit. So the debt holders accept lower return, so they accept the lower return. So this is incorrect, because it is less expensive, because of we are providing the benefit of conversion. Okay, and also you know that if you don't need this benefit, you can transfer to someone. When you transfer, you can charge a commission for this benefit. Okay, so other person can convert the shares and get the benefit. Okay, so likely to be that less expensive to service because of their equity component. Yes, it is less expensive, right? Likely to be more expensive to service because converting into equity requires the holders to make additional payment. Requires to be make additional payment. No, there is no payment required. There is no payment required, because these shares will be automatically converted into equity shares. Okay, so this is incorrect as well. So likely to be less expensive to service, because because they must rank after ordinary secured loan note. So less expensive because they must rank after. So you know that when the company pay any like return, like dividend, interest, or the repayment of capital, so first preference is given to debt holders. The second is given to preference share capital. The third is equity share capital. So there is no distinction between convertible and non-convertible loan note or debt holders loan note, right? So these are loan note. So there is no distinction here. Okay, there is no distinction here. There is no distinction here that this must be to here and convertible loan notes. So first it is debt holders, then preference shares holders, and debt holders include, these loan note holders include both convertible and non-convertible. Okay, and after this preference shareholder. So rank, there is no rank for, there is no additional rank for these ordinary uh, shareholders. So this is incorrect as well. So the only correct answer is this. It will be less expensive because of equity component. Okay, which of the following, which of the following is the best statement of the conclusion of M&M? It must be conclusion and the best statement. Okay, in on the relevance of dividend policy, dividend policy. Okay, shareholder in any type of market are indifferent between receiving dividend income and capital gain. Indifferent between dividend and capital gain is what? Is irrelevancy theory. Irrelevancy theory. So this is correct, but it's related to irrelevancy theory. Okay, the increase in retention result in higher growth rate. This is not related to M&M. This is related to golden growth. Golden growth. Okay. Discounting the dividend is not an appropriate way to value the company, to value the firm's equity. So the firm's equity, dividend, discounting dividend is not the firm's equity value. Why? Because the firm's value, the equity value is defined by the NPV, NPV of its future project. So, or I can say the equity value is defined by the future cash flow, future cash flow defined by the future positive cash flow. Okay, so the value of, so this is not correct, and the value of shareholders equity is determined solely by firms investment selection criteria. So equity value is defined by the investment selection criteria. If the positive NPV means the shareholder wealth will increase and the equity value will increase. Equity value will increase. So this is the conclusion and the correct answer. Okay. So if a company that currently pays its workforce at a piece rate, that is they are paying at variable cost, but now they are automating its production. So automating production will increase, will have to buy machine, and on that machine this investment plus this investment plus the depreciation they have to incur. Okay, so these are the fixed cost. Now they will incur the fixed cost. So which of the following response would it expect of operating gearing? Operating gearing means the fixed cost divided by variable cost. So now what happening is the fixed cost will increase, but the variable cost will decrease because we are moving from piece rate to production line automating. So the variable cost will decrease. So this operating gearing will increase, right? Because the fixed cost in proportion to variable cost will be higher. So operating gearing will increase. Okay, so next is what if a gearing company asset beta is used in CAPM formula. Okay, asset beta asset beta has asset beta is geared, sorry, asset beta is ungeared beta. If If a geared company asset beta is used in CAPM formula, okay, what will RI represent? This RI will represent, okay. So geared beta, so asset beta is ungeared beta, ungeared beta. Ungeared means no debt, okay. So it represent only the business risk of a company, and equity beta has is geared beta, geared beta, and it has the debt, okay, it has the debt. So geared beta has both risk, business risk and the financial risk, okay. So if this company is using the, if a geared company asset beta is used, if geared company's asset beta is used in the, asset beta is used in the CAPM formula, if the asset beta is used in the CAPM formula, means there is no debt. So this cost of equity will be ungeared, ungeared cost of equity, right? So this will be the ungeared cost of equity, okay. So next is, which of the following ratio is used to measure the company liquidity? So liquidity, for there is a formula for liquidity. This is current ratio, okay. This ratio is for solvency ratio, and these are profit ratio. So these are not relevant. This is the for the liquidity, okay. In relation to preference share as a source of, preference share as a source of capital for a company, fill in the gaps below to complete the sentence. Preference share are form of form of equity capital which carry, equity capital which carry higher risk for company point of view. So I will explain this, why this is a equity capital, because this preference share. So now your question is, this preference share is treated as debt. If it is treated as debt, then why it is considering as equity capital? So this can be your question, right? So the, when we calculate the debt to equity ratio, this preference share is treated as debt, but this will be treated, this will be goes into the SOFP as shareholder capital, really goes under the shareholder capital as preference share capital, okay, preference share capital. So it is treated as debt in case of debt and equity ratio, that the gearing ratio, but when we represent it into the SOFP, it is treated under the preference share capital, okay. So it has features of debt, but it will be considered under the equity capital, okay, the shareholders fund, okay, which carry higher risk. Higher risk means it has to preference of dividend and preference of dividend plus repayment of repayment of capital if this is redeemable debt. If it is redeemable, sorry, preference share, if it is redeemable preference share, then it will be paid before the equity shareholder, and the dividend we pay must also be before the equity shares. So they get the preference, okay, they get the preference over the equity. So this preference is, means this is risky for the company, right? Risky for the company, because we have to fulfill the obligations of preference shareholders. That's why it has the higher risk than ordinary ordinary shares. Okay. Next is what is the dividend cover ratio? What is the dividend cover ratio? Ratio, a measure of how many times company earning pay the dividend. Yes, this is correct, because the dividend cover ratio is earning divided by dividend. So how many times this earning paid the dividend? So this is correct. And this interest or coupon rate expressed as percentage of market price? No. Returns of the is taken off capital. This is also incorrect. And this overall dividend payout individual shareholders, this is talking about EPS something, so this is also incorrect. Okay. In relation to long-term lease, which two of the following is true? Lease agreement cannot be cancelled. Yes. Long-term lease cannot be cancelled, right? It cannot be cancelled. Many leases can be offered in sequence to cover the whole life of the asset. No, majority of life. Lessor retains the risk and lessor retains the risk and reward of the ownership. No, lessor transfer the risk and reward when the lease is created. So lessee is responsible for the repair and maintenance. This is correct. So these both are correct. In relation to which of the following statement is correct? In relation to irredeemable security, paying a fixed rate of interest, which of the following is correct? As risk rises, the market value of the security will fall. As risk rises, because when we increase the irredeemable security, the risk rises, right? Because the debt holders, they because the irredeemable the next the irredeemable security, when the irredeemable security rises, then it means it create a risk for the new finance providers, because they see that this is a risky company, so the risk will increase. See, the risk rises, the market value of security will fall, and to ensure that investors receive an increased yield. Yield means yield 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 is yield is earning whatever you earn divided price. Okay. So when the risk rise, when the risk increase, the risk increase when the risk increase, the share price, they sell the shares, sell they sell the security, the share price will fall, so the share price will fall, so the yield will decrease, right? Decrease. Sorry, when the share price fall, the earnings will increase. Earning will increase. So this is correct. So when the price fall, the denominator, the earning will in proportion to price, means the yield will increase. So this is correct. Investor receive increase. Yes. Rise risk, the market value of security will fall. Market value of security fall, yes, to ensure that investor receive reduced yield. No, increase yield, right? As the risk rise, the market value of security will rise. Okay, this is incorrect, because the security rise fall, not rise. This is the only correct answer. So now you understand that when we increase the security, the irredeemable debt, because the new new providers of finance assume that the company cannot pay this cannot pay repay back this principal and the interest, so they see this company as a risky company, so their risk will increase. When they see their risk will increase, so the existing shareholders will sell existing security holders will sell the security. When they sell the security, the price will fall. The price will fall. When the price fall, the yield will increase, because the yield is the proportion of earning and the, okay. Next is, what is the theoretical value of right price for this existing share? Okay, so value of existing shares and the value of new shares. So value of existing share is 4 multiplied 4 multiplied 8 4 multiplied 8 plus the new shares we have the value of 1 6, and this will be divided by 5. So what is the TERP? The TERP is 4 multiplied 8 equal 32 plus 6 equal 38. 38 divide 5 equal 7.6. 7.6. This is the TERP. Okay, so TERP 7.6 minus the right issue value. This is 6 divided by the 4. Okay, divided by the existing shareholders. Okay, existing shareholders is 4. We are considering 4 here. Okay, 7.6 minus 6 equal 7.6 minus 6 equal divided 4 equal 0.4. 0.4 dollar. Okay, so next is SME. SME can have difficult in raising finance due to maturity gap. Which of the following best explain the maturity gap? So maturity gap is the difference between the because the long term funding is easy to obtain. Long term funding, long term source is easy to get. Short term hard to get, and long term is easy to get because it is secured against asset. Okay, so business find it difficult to obtain short term funding, but easier to obtain long term funding secured against the asset. Okay, this is the maturity gap. The lack of available funds from shareholders. No, the venture capitalists need an exit route for their investment within a specific time period. No, the lack of business history makes borrowing more risky for lenders. No. So you just need to understand that which one is correct. Okay, so we have to choose only one. So this is correct, and rest don't make any sense, because the examiners have to give you 4 options. So they try to create as many confusion as they can. And what is the theoretical exit price? Okay, if the Frost company is planning 144 issue with the issue price of 10% discount to the current share price. Okay, so the EPS is this currently Frost company trading on the on a price to earning ratio of 20 times. 20 times. This is price to earning. Price to earning is 20 times. Okay, so this earning is 0 0.5, 0.5. So the price is, price is 20 multiplied 0.5 or 10. So the price is 10. Okay, so the price is 10, but it is issued at 10% discount. So this is 9. It is issued at 9. The market capitalization of the company is 50 million. Okay, so now we have to calculate the TERP. So this for the existing shares, the market price is 10, and for the new one, the issued at 9, and we have to divide it by 5 total. Okay, so the answer is 40 plus divide 5 equal 9.8. 9.8. Select the correct term to complete the below sentence. Okay, SME, restricted access to capital market. Yes, the difference between finance required to operate the SME and finance obtained is known as the funding gap, right? This is very simple. Green company, a listed company, has the following share price during the year ended, start and highest to lowest. Okay, during the year, green company paid dividend. This total shareholder return. Total shareholder return is dividend plus capital gain. Okay, and this must be divided by price at beginning. So it is the income, this income divided by the price. Okay, so this is the formula, and dividend is 0.15 plus capital gain is how much? 3 minus 2.5. So and the price is 2.5. This is the answer. Need to solve it. We get answer 3 minus 2.5 equal plus 0.15 equal divided 2.5 equal, and you have to multiply it by 100, convert it into percentage. So this is 26% total shareholder return. Okay, next is the what is the cost of equity. And our company announced that it will pay annual dividend of 55% of earning. This is the dividend, 55% of earning, and its earning per share is 0.8. So dividend is how much is the dividend? This is the dividend, 8, right? 8 multiplied 55%, 0.44 is the dividend per share. And it has 10 million shares in issue. 10 million is the shares. The return on equity of car company is 20%. The cum dividend share price. Cum dividend, it include the dividend. So X dividend, X div share price is 4.6 minus 0.44. Okay, so how much is the active share price? Active share price is 4.16. Okay, we have to use the active share price to calculate this cost of the. So the earning is the return on equity of the car company is 20%. Return on equity of car company is 20%. Return on equity is 20%. Okay, so this is the return. Is the return we have given, and so cost of equity is T01 plus G divided by T0 plus G. Okay, so we have this T0 is 0.441 plus growth, we don't know the X due 4.16. So we need to calculate the growth. G equal BRE. BRE. What is, how much is the retained? Retained is 100 minus 55 is 45 is the retained. 5 retained and rest is distributed. So 0.45 multiplied 0.2 the return. Okay, this return, and this is the retained, and this is the return. Okay, when we multiplied these, we will get the answer of 9%. 9%. So growth rate is 9%, 0.09, and have to use 0.09. So now the answer is 1.09 multiplied 0.44 equals divide 4.16 equal plus 0.09 equal, this is the 0.205288. So multiplied by 100, you will get 3.20.52. So this is the cost of equity. Okay, let's move on to the next is, what is the operating gearing ratio. Operating gearing, what is the operating gearing? Operational gearing, what is the operational gearing? Measured as contribution divided operating profit. Okay, so the contribution is sales minus the variable cost. So 70% of the cost of sales is variable. So 180 sales variable cost is 70% of that 180, and 180 70% of this is 80 and 126. 126 is the, sorry, it is 70% of cost of sales. 70% of cost of sales. 70% of cost of sales. Cost of sales is 100. So this is the 70. This contribution will be contribution. This is the 110. Okay. Now we have to calculate the operating profit. Now we have to calculate the operating profit. This one, so this is operating profit is PBI, before income tax, profit before income tax, before income tax. This is operating profit is given here. It's given here. So 110 divided 80 equal answer is, and it must be in times. Okay, 110 divided 80, so 1.375, 1.37 and 375 times. Okay, or one decimal, so we can say that it is 1.4 times. Okay, let's calculate this. What's the TERP per share and the right issue per share? Okay, and the correct items in the drop down. Okay, so Y company is planning to issue one for every 4 right issue. The value of right has been calculated. Value of right, this is the value of right existing share, and this is the market price. Okay, so the TERP is what? TERP is market price before right issue, less value of it per existing shares, value of right for existing share. Okay, so TERP is market value before right issue. How much is this? Is given 7 minus the value of right per existing share. Value of right is given, so 0.4. Now this is 6.6 is the TERP. This one 6.6. So now we have to calculate right issue price. So right issue price is right issue price is right issue price is value of right equal TERP minus right issue price. Okay, so the value of right is value of right is 1.6, 1.6, because this 0.4 multiplied 4 equal 1.6. Okay, this is the value of right, and TERP is 6.6, and the right issue price we have to calculate. So this will go this side. So right issue price equal 6.6 minus 1.6. How much? 6 minus 1.6 is 6 minus 6 is 5. So the right issue price is 5. You just need to understand this formula, then put the numbers and you will get the answer. Okay, so next is SME often face funding gap problems. Yes, right. Indicate whether the following statement about SME true or false by selecting the correct answer to the relevant statement. Okay, SME often experience funding gap, yes, due to them being seen as a high risk. They face funding gap because investors see them as higher risk, higher risk investment. So high risk means they don't have business history. Because they don't have the business history, so the investors don't invest in these type of businesses. Okay, so this is true. Founding shareholders of SME will often have to sacrifice limited liability in order to obtain the finance. Yes, because because they have to give the personal guarantee personal guarantee of assets in order to get the finance, because they don't trust the small businesses. That's why they need to give personal guarantee, okay, to get the finance. A lack of suitable sufficient non-current asset increase the funding gap. So because of unsuitable non-current asset, they could not get the finance. This is also correct. Okay. Next is, which of the following is available for a listed company? Yes. Okay. Using dividend growth model, what is the cost of equity? Is the cost of equity. Okay. So the cost of equity for dividend growth model, D1 plus G, D0 plus G. Okay. So what is the dividend? Dividend recently paid is 1 plus into 8. This growth is given. The growth is 8%. Okay, 0.08. Okay, plus 0.08 given, and we have to calculate the P0. P0 we have to calculate, and for this we have given the price to earning. So PE is given, price to earning ratio is 5. I can say this is MPS, market price per share, and EPS. Okay, so we all have also given the dividend cover. Dividend cover is earning divided by dividend. So this is the formula. So dividend we have given 0. Dividend is 0.1. Okay, 0.1 is the dividend, and earning we will calculate, and dividend cover is 4 times. So you have multiplied it, you will get the earning is in this is 0.4. Okay. Okay, so earning we have now calculated. We need to put this in the formula. So earning is 0.4. So we will get the price. Price is 5 multiplied 0.4 is 2. Okay. So we have now the P0 is 2. Now we have to calculate this. We will get the answer of 0.134. That is when we multiply it by 13.4%. 13.4% is the answer. Okay. Next is, what is the value of share price in relation to these values in cent? Okay, a listed company has dividend yield. Dividend yield is earning divided market price. Okay, so this is given as 9%. So this is 9% based on most recent dividend is this. What is the value of share price in relation to these values? We have to calculate this market price. Okay, this market price. So this is 9%. Okay, 0.09 equal earning is, we are considering the earning dividend as earning here. So market price is 0.35 divide 0.09. So we will get the answer of 0.35 divide 9. We will get the answer of $3.89. When we convert it into cents, so we will get the 8 in cent. Okay, in cents. This is the answer. Okay. So next is if the issue if the issue if the equity issues goes ahead and bank loan redeemed. Okay, so what is the earning per share? So you know the formula for earning per share is earnings divided by the number of shares. Okay, so let's read this question. Beaver company has 100 million equity shares in issue. Right now they have the 100 million and I just reported a profit after tax. This is the profit after tax and new issue is 50 million. So new issue is 50 million. So we already have the 100 and 50 is new issued and has an issue price of 1.5 being considered. All proceeds were used to redeem the bank loan and which has the annual cost of 8%. The beaver contribution tax rate is 20%. So we issue the equity shares of 50 for 1.5 and from these proceeds of equity shares we redeemed the bank loan. Okay, so our earning is profit after tax, that is 55 plus the saving we did because bank loan redeemed. So how much is the bank loan redeemed? 50 multiplied 1.5 equal how much we redeemed? We have redeemed the bank loan of 75 million. Okay, 75 million. Okay, from this 75 millions we redeemed, we, we saved interest. Saved how much? The interest saved because we redeemed this bank loan, so we don't have to pay the interest on that, so we are saving the interest. So interest is 8%, so 75 is 8% is 6 million, and on that interest now we also have not saved the interest. Now this saving must be after tax. After after tax saving is 6 1 minus 2.2, 20% is the tax rate, so after tax saving is 4.8. We have this as well, so our answer is $0.399. Okay, this is the earning per share. So now I have completed this whole MCQ of chapter sources of finance, and this another is the cost of capital. Okay, so now you have to read the book and solve these questions. If you don't understand, watch my lectures, watch again this exam kit solutions and try to solve by your own. Okay, and try to memorize the formulas and practice on that as well, so you will be comfortable in your exam. Hey everybody, my name is Neeraj Sen. Thanks for watching. If you are benefited from the lecture, consider like, share and subscribe. If you have any questions, leave them in the comments below. I will meet you in the next video.